but I'm sure there are many questions. So I'm now going to open up the floor. This remains on the record until Rick cuts it off. And we will take people. Please identify yourself and your institution when you come up.
I'm Tom Pally. I'm an economic consultant in Washington. I'm sorry.
Certainly. Should the inflation target be core inflation or headline inflation?
It should definitely be headline inflation. But I would never use the word inflation target here, by the way. It's very, very critical. The problem with the word inflation target is it looks like you have to hit it over a particular horizon. One of the things I very much emphasized in this speech and this particular proposal is that, in fact, a horizon should not be fixed. Indeed, the science of monetary policy says that depending on the nature of the shocks, you should have a different length of time to which you want to get to the mandate consistent inflation rate. And that's exactly why I've couched this in this way. The issue here is not that the core inflation rate isn't a useful measure, and I have a whole speech on this issue of core versus headline, which goes into more detail. But clearly, what people care about is not some measure of core inflation which can strip out certain items. They care about all the things they pay for. So clearly, core inflation takes out the gas pump. And believe me, people right now care a hell of a lot about what the price they're paying for gas. Luckily, since I've been in Washington, I put less than 500 miles on my automobile. So it basically sits in my garage next door. So it hasn't affected me as much, but it is really, really very important. So one issue is when we talk about our goals, it should be in terms of the inflation rate, which actually affects people, and that is the headline inflation rate. The second issue is that a core inflation rate, and I'll talk about how that can have its uses in a second, the core inflation rate, because it arbitrarily strips out certain items, may actually be a biased estimate of what the long-run headline inflation rate would be. Particularly, you can strip out parts of inflation, which in fact may have different rates of productivity growth than the average item in the consumption basket. And as a result, over time, there could be a divergence between core and headline. And this is why a goal should absolutely be put in terms of headline inflation. On the other hand, I do think it's very useful to actually talk about core inflation rates. In fact, one of the things I should mention is something that I was very enthusiastic about when we did our communication enhancements in October of 2007, was that before that we only had projections on core, and then we added headline. And it's exactly because of this reasoning that we ended up in that direction. I was a very strong advocate of having headline inflation in those projections. Nonetheless, there is a value to looking at core, and in two ways. One is this issue that I've already mentioned, that you do not want to, in fact, try to hit headline inflation rate over short horizons, headline inflation rate goals over short horizons. That actually would be something that would be inappropriate in terms of monetary policy, would not focus sufficiently on the dual mandate. So from that viewpoint, in the shorter horizons, the core tells you more about underlying inflation. And so reacting too much to headline instead of reacting more to core could lead to bad outcomes. And in fact, in the speech, I actually do some simulations. So I'll talk about some simulations, which indicate how much better you do by not focusing on headline in the short run, even though in the long run you should. So that's an important issue. The second issue I think that's very important, too, is management of expectations. That monetary policy should be responsible for what it can do, not what it can't do. And a lot of short-run movements in headline inflation are completely out of control of monetary policy. So it's really clear that this is going on now, that the Federal Reserve does not control what goes on in the Middle East, or does not control the fact that there are certain countries which are having trouble producing as much as they could because they have very inefficient oil sectors. So in that context, we've seen a huge explosion in terms of energy prices. This was not because of anything that we did. This is because of supply and demand factors in the energy market. The advantage of talking about core is that it tells you much more about what the Fed does have control over, which is underlying inflation. So in that sense, by actually talking about core, you can actually say, is the Fed doing a good job? So this is like Mayor Koch. I'm a New Yorker. I love Mayor Koch. He used to always say, how am I doing? And in fact, not only should we always say, how are we doing, but people say, how is the Fed doing? And in fact, in terms of shorter horizons, core inflation rate tells you a lot more about how the Fed is doing than, in fact, headline. So my view on this is that we've been very clear that for goals, headline inflation, but in fact, there's very positive value to also focusing on core inflation in terms of thinking about the way we actually do monetary policy.
Thanks. Tom, I'm sorry, you're next.
Tom Powell, I'm economist here in Washington. Arithmetic is a rather tough mistress, imposes kind of logic and bounds on one. The core, not the core, the headline inflation rate has now been running at above 4% for quite a long time now. If you have a 2% long-run inflation target, are you proposing that we have a little bit of deflation down the road? We have to get back to that average to make it long-run credible. How do you do that when you have an overshoot? You've got a lot to make up now, in other words.
Well, here's the issue, and in fact, there's a whole technical issue about price level target versus inflation rate. I don't want to get into here because it'll get too academic. But the first issue here is that the fact that the headline inflation is very high is a reflection of the fact that relative prices have to change. We have a huge increase in energy prices. Hopefully, by the way, energy prices will go down. We just actually had a decline in oil prices, which to me is very welcome. But in that context, when you look at what's going on, that in fact, if energy prices can't keep on going up forever, in fact, that means the headline inflation will come back down towards core. And so in that context, our core inflation is around 2%. And so the expectation, if you look at the projections that the Federal Reserve participants put out that were just released in the minutes, you'll see that in fact we expect that headline inflation will come down to around the 2% level over the 3-year horizon.
You've got ground to make up now. You can't always be persistently
Okay, so
side
right. There is an interesting second issue, which is a very active debate in the academic community right now, which is whether in fact you should have some mean reversion in terms of inflation in the following sense. And mean reversion actually to a so-called price level band. There is an argument in the literature that in fact that would have positive benefits in terms of expectation dynamics, and that actually could act as an automatic stabilizer for the system. This is very much associated with people like Mike Whither, who talks about history dependence. In that context, having some element of averaging in terms of how well you think you're doing in terms of inflation can have benefits. But there are a whole lot of other issues that come up in terms of whether in fact that could create some other kind of problems. So if we talk about this, actually I talked about this issue in a monograph that I did evaluating the Swedish monetary policy that I did for the Swedish Parliament, which came out before I was here at the Fed, which talks about this whole debate. So I'm going to just leave it there because we'll get too many people sleeping here. So I want to keep this lively. It's a little hot in this room, so I don't want people passing out.
We're working on it. The heat is yours. Andrew.
Nice to see you, Andrew.
Thanks. Rick, I think the Bank of England regards the fact that their price target is set by the government as being, in some sense, a protection for them. Now, you've talked about the mandate consistent inflation rate. Will those who set the mandate, namely the Congress, want to have some voice in talking about or endorsing the mandate consistent inflation rate? And would that be good or bad?
So it's actually very interesting that we had a lot of discussion about this in our book. And it has to do with the way your political system is set up. I'm not a political scientist, so I don't know the terms, but there's a congressional system versus a parliamentary system. I don't know if that's the technical term. And the parliamentary system is actually much easier to have the government involved in setting the inflation goals. And the reason is that the separation between the legislative branch and the executive branch is much less. So, in fact, one of the remarkable things that I didn't understand at first was when a new government came into power, in the Tony Blair government, and they actually announced a change in the independence of the central bank and announced an inflation targeting regime. And it was actually done without legislation at that point, because once the government came in, they said they also control the legislature, they can do it. So in that context, it's much easier to do this, and it's much, much more difficult to have this happen in a congressional system. Who should set an inflation goal? Should it be the executive branch? Should it be the president? Should it be the Congress? Who should do it? So it's actually very much more complicated.
Well, the same one that sets the mandate, in this case, the Congress.
Well, so there is an issue that, in fact, the Congress could be involved in doing that. My suspicion, however, is that what we've seen, and we've seen in many other countries, in fact, Sweden's a wonderful example of this, which is that the Riksbank actually decided on the inflation goal and announced it. Did not do that under legislation because it didn't need to. Over time, actually within a couple of years, then the government said, sounds good, that's a good number. They chose a 2% number and the government then acceded to it. That was a positive, by the way. But I think that there is an issue, a technical issue in terms of this, that in fact, in almost all cases when the government sets a goal, they actually consult with the central bank. So in practice, it may not make that much difference, but there still always is this tricky issue of who in the government should be involved in making decisions like that. And it's much more complicated in a system like ours, which has a president and a Congress, versus one which has a parliament, as in Sweden or the UK.
Fred?
Fred Bergston from the Institute. Rick, let me echo Adam's welcome to you today. It's been great to work with you while you've been at the Fed. We look forward to remaining in close touch as you return to the academic world. Your topic today was communication strategy of the Fed. And you did not explicitly address the question, communication to whom? So my question is the following. Most central banks are primarily addressing a domestic audience when they outline their policy goals and instruments. But obviously, when the Fed speaks, it speaks to the world. So when you think about Fed communication policy, does that alter your conclusions in any way compared with if you were operating in a small, closed economy where you didn't have the global currency role as the dollar does? So A, does the global role of the dollar affect your thinking about communication policy? Second, we're now in a world where, as your frequent references to the ECB imply, we've got a second global currency of increasing importance, the euro. Does that mean that there should be increasing coordination between the communication policy of the Fed and the ECB, since the rate between them is the crucial rate for international financial purposes?
So I think the first thing I'd say on this, which is that having a credible announced inflation goal, in fact, is very helpful in terms of planning, not just in the domestic economy, but also for foreign economies as well. And in fact, what you'd like to have in terms of exchange rate fluctuations is one that are due to real factors, but not to concerns about what your commitment is to the nominal anchor. So one thing that helps stabilize, but not because there are good reasons for exchange rates moving, and maybe some not good reasons. Markets do whatever they do. But one thing that you'd like to do is not to have exchange rate fluctuations occur because of changes in views about what people are going to be doing in terms of controlling inflation. And so in that context, I agree with you that, in fact, the communication is even more complicated. It's not just domestic, it's who in domestic. You got to communicate with the public, you got to communicate with the markets, and you got to communicate with the politicians. And they all have very different sophistication in terms of economics. So that's tricky enough, but you're right. There's then the issue about what are you doing in terms of clarity in terms of foreigners as well. Because what happens in the US is very important what happens there. In terms of this proposal, having a clear-cut numerical inflation objective stated by this Federal Reserve, I think would only make it easier for foreign policymakers. In the same way that I think it actually makes it easier for us to understand where the ECB is in terms of thinking about policy. Do we need coordination in terms of policy? I'm not sure that we do. There's a whole literature on macroeconomic coordination, which is very, very complicated. The area where it's clear that we need coordination is in terms of regulatory and supervisory policies in the financial system. And indeed, there is tremendous coordination in that context. It's much more complicated in terms of issues of monetary policy. In general, if you're pursuing monetary policy which is appropriate, i.e., you're basically thinking in terms of optimal monetary policy and communicating that, which is exactly what this whole proposal is about, that basically works out just fine, particularly for large other players. It can get complicated, by the way, for some countries which decide to peg their currency to your currency, and you're doing what's optimal for you, and it's not optimal for them. But then that's an issue about whether they should peg to your currency or not. And this, of course, is a major issue. It's not the subject of this speech, but you have plenty of people, and you've written on this, and you have plenty of people in your shop who've written on these issues.
On that note, I would just point out that Ted Truman, his inflation targeting book for us, had a chapter about talking about common G3 inflation targets, and Vince Reinhardt, I believe Carmen Reinhardt, co-authored a paper a few years back in the AER on that topic as well. So we're all engaging on this issue. It's hardly a closed issue.
And actually, and in practicality, if you look at the inflation objectives that central banks around the world have chosen, they're all around the same number. Very, very small differences. The difference is actually a little bit larger for emerging market countries because of the Lassus-Sanderson type issues. But for advanced countries, almost everybody you know, the numbers are usually between 1.5% and 2.5%. There's very little variation.
I have Mike Prell next, and anybody else should signal to me if they're interested.
Thank you. I guess I have two questions. One is maybe merely rhetorical at this point, and that is acknowledging that we live in a world in which there are shocks all the time, as I'm sure you would. What is the credibility and utility of this numerical target? I'll use the word, recognizing your concern there. If bygone deviations are forgiven, and yet to be deviations will be forgiven, what is the meaning of this in terms of really providing any concrete basis for assessing performance and for shaping expectations? The more in the vein of a question is, these arguments that you've made are understandable, and I think have been made by many people over time, and must have come up in your own communications discussion and the extended debates you had internally. So what is the internal governance steps that might have to be taken in order to implement this kind of innovation?
Well, in terms of internal governance, it's really not that complicated because it just requires that the FOMC decides to make a decision, i.e., you can make a decision that you'd like to come to a consensus and people agree to it. And so that's something that's completely feasible if, in fact, the FOMC wants to do it.
I wasn't asking on a theoretical basis, on a practical basis.
No, but that's exactly right.
He responded.
But I think that's right. In terms of the other issues that you've raised, I think actually this is exactly one of the reasons why you want to talk about paths in terms of both inflation and output, and what you think are optimal paths. So what I'm actually describing here is that you think in terms of paths. So you say, what is a path that looks good to me? Because we have a dual mandate. That we get a shock, it may shock inflation away from our long-run goal. And by the way, not just on the upside. We've had many cases of actually inflation rates which have gone too low. And then there's a question about how quickly, what kind of path is appropriate to get it back to its long-run desirable level. And as part of that discussion, you're then going to be saying that that influences what we think is going to happen in the output path. And again, we want that to be desirable. So the way Laura Spencer describes it, so there's two ways of doing this. One is we can get fancy and do optimal control simulations. That's one way of doing it. Another way that Laura Spencer has described it is you put out different choices of paths. So you choose a path for inflation that has an implication for what path you would expect to happen in output. And then the committee would look at it and say, what looks good? So I call this the Mikey likes it approach, for those of you who are a little bit older and know what I'm talking about. But does Mikey like it? Does it look reasonable? And that's actually exactly the way you want to think about doing monetary policy. And this approach, first of all, in terms of internal deliberations, exactly is saying that's the way we should think about it. But one of the things that I talked about in my comfort zone speech, which is one of the problems that we have right now, is that when you sit in a committee where people have different inflation objectives, then you're never sure that the reason that they're talking about their monetary policy is because they have a different view of the economy, or a different view of how interest rates settings affect the economy, or they have a different inflation objective. So in fact, you want to get away from the hawks and doves type thing, where right now they talk about hawks and doves because there are people with different inflation objectives. And you saw that in terms of the dispersion, in terms of people's 3-year projections when in fact we didn't have the kind of shocks we have now. So that would actually benefit things in terms of internal discussions. And in fact, I will tell you, I think there has been an improvement in internal discussions since we actually went to the 3-year projections, and we do it 4 times a year, because people are thinking in terms of paths. But as I pointed out here, there's a sense in which, where we are now, it's not as tenable because of the fact that the 3-year horizon is not providing some of the information that we need to provide. The second issue is, from an external viewpoint, it's very important that people understand what you're trying to do and how you're responding to shocks. So you're absolutely right. We're going to have shocks all the time. And in fact, we've had really big shocks lately. In fact, if anything, we've had a perfect storm of shocks. As an academic, this is very exciting, but as a policymaker, it's very stressful. But you know, it would have been hard enough if we just got the goddamn shock in terms of financial issues. The reason that's hard enough is because it's very nonlinear, the impacts that it can have on the economy, so it's a little bit more complicated in terms of forecasting, in terms of exactly what you do. But at least if that was all that happened, you know what the answer is. You want to actually ease policy. But at the same time, we then got this horrendous shock in terms of oil prices. which means that it's a much more complicated environment because, as somebody pointed out, we have very high headline inflation at the same time as we have a very contractionary shock in the financial sector. So as an academic, it doesn't get any better than this. As a policymaker, it doesn't get any worse than this. But the point is that then when you get these shocks, you want to say how you're going to respond to them. And the right way to think about that and describe it to people is by saying, here is what we think is an appropriate path in the variables we care about, given the kind of shocks, and here is how we're going to actually try to get there with the kind of monetary policy we pursue. And that can be very beneficial both in terms of accountability, to actually start to understand why the central bank is doing what it's doing. Allows people to say, gee, we don't think you're doing it right, or yes, you are doing it right. And also it helps in terms of decision making, because one of the key things that central banks should try to be is they should try to be boring. You want people to understand what's going to happen in the future to the best extent possible, never get it completely right because of all these shocks, but the less uncertainty and the more boring things are in terms of the macroeconomy, the better.
Keeping with the boring theme, Ted Truman, Vince Reinhardt.
Not in these guys are boring, by the way, so it's okay.
I meant humor.
Ted Truman, I'm here from the Institute, so I'm sure you appreciate many of you that you're getting some dimensions of Old Home Week, or, I mean, use the expression Old Farts Week.
Speak for yourself, Ted.
Well, you're younger than some of us. So the question, I have a two-part question. And it comes to, as you mentioned, the policy assumption underlies your framework, right? Which you didn't fool around with, which is you assume that monetary policy will be appropriate to achieve your target. And the problem with all I've always bothered me is that in that world, or maybe just even, and that's part of the second part of the question, inflation expectations and the anchoring of inflation expectations are endogenous. Right? So ultimately, those expectations will be affected by how well you do your job, even if you have a range of shocks and so forth and so on. The presumption now, just as is that the Federal Reserve will do the right thing, and therefore when it puts out the forecast for 2010, that is something that is, leaving aside whether, that is something, it's presumed that the Federal Reserve will achieve that, because the Federal Reserve will do the right thing. And that's built into the process. But of course, the Federal Reserve may do the wrong thing, or not enough of the right thing, or whatever you want, however you want to put it. And so, in some sense, either form of it, the longer horizon or the mandate consistent long-run inflation objective, and tacking down of expectations is eventually is dependent upon whether you deliver. Now, you can actually buy quite a lot of time in the short run. So one question is a radioactive general question, and then my assumption is that one of the reasons why central banks have, well, you can correct this if you live with them all the time nowadays, I only look at a few speeches, have gone to publishing interest rate targets, or interest rate paths associated with their inflation tags, is actually to say explicitly or more explicitly about what the right thing means in terms of achieving the inflation objective. So that's half the question, whether you think that one is to comment on the general question of endogeny of inflation expectations.
It's not just a question of what you say, it's a question of what you do. And particularly important in this regard is that, and there's a lot of literature on this, which is how important management of expectations is to monetary policy, the success of monetary policy, that the actual thing that you do today, in terms of whatever comes out of the FOMC meeting, is not what's really critical by itself to the impact of monetary policy. It's what you do today in terms of what indicates for what you'll do in the future. So very key in this whole argument is that having a longer inflation objective actually can help pin down inflation expectations and in fact provide information. But in fact, if you say one thing and then do another, it's not going to work, and in fact would not be helpful at all. So the way I think of this is that management of expectations and words matter, actions matter, but it's the combination together that's really powerful. If you do one without the other, if you have actions without the appropriate management of expectations, so for example, in the case of the Bank of Japan, they did quantitative easing, but in fact there was a view out in the world that in fact they would reverse it as soon as they could, and in fact would raise interest rates, which they actually did at one point. I think in 2001 you wrote a book on this, Adam, so you can tell me the exact dates. And as a result, it was not an effective policy. So here was a question of actions were reasonable, but the words went the wrong direction, and as a result, the actions didn't work as well. Similarly, if you say, I'm going to control inflation, you're not serious, and don't take the right steps, then in fact it's not going to work. One of the advantages, though, of this clarity, though, is it makes you much more accountable. When you say this is what we're trying to do, and here are these paths you think are appropriate, and if you're doing stuff that's completely inconsistent with it, the people in the market's going to have a great time saying to you, you know, you're not living up to what you're saying you should live up to. That we now have more information about what you're saying and doing, and in fact, we think you're not telling the truth, or you're just incompetent, whatever. It creates the kind of public debate in terms of actually making sure that the central bank is more likely to, in fact, do the right thing. So you're absolutely right that inflation expectations are endogenous. Words can have an important impact, but it's the actions with the words. In fact, if anything, actions are more important because that's where the metal comes to the road, whatever you call it. But, you know, yeah, right. Right, rubber hits the road. I got it now. So I think that you're absolutely, the critical aspect of this is that you have to think of these as a combination, and that's very important. The second issue I think that's related to this is the issue of institutional frameworks versus basing things on personalities. So in my writings on this in the past, and one of my criticisms of the Federal Reserve not operating with more clarity was that everything is based on personalities. And so the statement that I made in a paper of mine well before I came to the Federal Reserve as a governor was I said the U.S. has a strong nominal anchor. The Federal Reserve has been very good at creating a nominal anchor. The nominal anchor is Alan Greenspan. And now we're in a situation where we've been very lucky to have somebody as talented as Ben Bernanke become the chairman. And also, by the way, he's just, you know, you don't get anybody with more integrity than this man. He's really a wonderful human being. But you're in a situation where we've been very lucky with having a very good Federal Reserve chairman. And in that sense, the personalities help create the commitment to price stability. But systems which actually have good institutional frameworks, so that if you don't get somebody great, you still do very well, actually are very, very beneficial. So in a sense, my arguments here are not just to deal with the situation as it exists now, but is really talking about more difficult situations in the future where you may have Federal Reserve chairmen which are not as committed to controlling inflation, or may not be as skilled as Greenspan and Bernanke both are. And in that case, having a good institutional framework, which is really what I'm describing here, can be very helpful. And the way I think about this is that the United States, that we have a constitutional framework that has served us extremely well. And it's not true that we've always had great leaders, but this country has done very, very well over time despite that. And then you go to other countries where sometimes they have a great leader, and then the great leader dies or gets too much into power, and they just don't have the institutional framework, and they don't do very well. So it really thinking about how you set up an institutional framework, so it's not the personalities, but personalities still matter. Having somebody good at the head of the central bank, even if you have a great institutional framework, makes a big difference. But in fact, having a strong institutional framework will actually protect you and actually make it more likely that good decisions will be made, and also will involve a good institutional framework in terms of the interaction between the political process and the central bank process, so you get good outcomes as well. And this is again a feature of what we've seen in a lot of these regimes.
I would just point out, so before going to the last question, in your packet, there's a new paper done by the Institute exactly on this point that Rick mentioned. Ken Kuttner and I just did a working paper establishing that central bank governor turnover at the Fed shocks markets much more than in other central banks where there's a more explicit framework. In central banks where there's more explicit framework, turnovers in governor have very little impact on markets. There's a statistically significant difference. Just an illustration of the basic philosophy Rick was talking about, but conveniently in your packet along with our other good works. I'm now
that was actually helpful to me and also helpful to the Peterson Institute. I like that. Good on that
We,
one.
we believe in win-win here. And in that spirit, we'll turn to Vince Reinhardt from API for their final question.
Let me first follow up on Ted's question. The forecasts you want to extend are based on appropriate monetary policy that's undisclosed and could vary across the individual survey participants. Is that an advantage or disadvantage of your proposal? And if it's a disadvantage, what would you do about it? Second, you've talked a long time about price stability. A common complaint at this juncture is, why do you limit your discussion to a responsibility for consumer price stability? Where does asset prices figure into your calculations?
So remind me the first question. I'll do that one.
Appropriate monetary policy, different across members,
So
undisclosed.
there is an issue here, and it's a very important one, and it relates to the question that Ted, I forgot your second question, Ted, so Vince is getting back to it, which is the whole issue about whether you should in fact provide information about what your policy instrument rate is going to be in the future. And this is a very tricky issue. By the way, from pure theoretical models in economics, it's very clear that in fact, to get the full benefits of some of the things I've been talking about, you would actually want to not only tell you where you're going in terms of the variables which are influencing, like output and inflation, but you'd also try to tell people about what you actually think is an appropriate path for monetary policy. And in that case, the models are fairly clear-cut. The problem is when you get to the practical world. And one of the concerns that I've raised in earlier work on this, although I'm very sympathetic to that argument, the problem is whether you in fact can communicate this well enough. And the concern that I have is that if you provide a policy path, will people actually understand that you're under zero probability will you always hit that path? That in fact it might be the modal forecast of what you think is appropriate. And of course that's the way these projections are done. But on the other hand, we know that there are going to be shocks to the system which actually should indicate you're going to move away from that path. And in fact, the difficulty here is that if you then moved away from the path, will people think you're flip-flopping? Or will you actually adhere more to a path that will in fact not be the right one? So where I got very worried about this, I was never a fan of the measured pace language. I just did not think it was a good policy at that time, and wrote about it, so I'm not saying anything new. And the reason I had this concern was that every meeting, it was really boring. Thank God I wasn't a governor during that time. Vince watched the deliberations, but I would think that sort of go like this all the time, because every meeting, what were you going to do? 25 basis points. So the discussion, probably the only interesting discussion is when might we stop. But the difficulty is that I think it might have constrained the Federal Reserve in terms of its path. I don't think the outcome necessarily would have been very, very different, but I think there was particularly danger. I remember early in 2003 there was an inflation scare, which luckily went away. But in fact, if that had become more serious, then in fact it would have been necessary that the Fed deviate by raising interest rates by more at the time, and if it didn't do it, it would have created big problems. And, or if it actually then did it and got in trouble politically, that could have created big problems. So there's a tremendous subtlety here in terms of communication. So when I debate these kind of issues with people like Lars Svensson, Lars Svensson's a purist. And Lars basically says, here's what the model says, giddy up, let's go with it. And I said, yes, but there's also a political economy feature. And in fact, if you think about the proposal they've laid out today, it has a lot of political economy features. So there are really two key features that I think are very important in the proposal, which is one is that I really emphasize the dual mandate. This is really important, both from the point of view of doing good policy, because some of the critics of the inflation target have in fact not understood what appropriate inflation target would be, so they make comments like, oh, they would then try to actually get headline inflation immediately down to an inflation goal, and that would be a disaster, and therefore very critical. And clearly, one of the things I want to emphasize here is that dealing with the dual mandate is appropriate. It's what every macroeconomist that writes down a model of optimal monetary policy deals with by putting an objective. I'm going to be technical for a second. The objective function always has pi minus pi star squared, deviations from a desirable level of inflation, and has y minus y star squared, which is deviations from the natural rate of output. There isn't one. If you don't write that down in your thing, you get in trouble. Everybody starts yelling at you. So this is standard way to think about doing optimal policy. And the proposal I'm outlining here is very much consistent with that. That needs to be made clear. And in fact, I've been critical of some central banks in their past writings that have an inflation targeting regime that doesn't make that clear or has fixed horizons. So very important to get this right. The second issue is the evolutionary aspect, which is the Federal Reserve has a long history, particularly in communications, of making small incremental changes. And actually, when I started the Federal Reserve, I thought that this is, just why don't you just get it right? But I think there is actually some real value to doing that because you learn. So you make a change, see whether it works, Mikey likes it, and then if it works well, you then keep on going. And in fact, in this context, what I'm arguing here is that we've moved in a direction which is very positive, but in fact still has a substantial room for improvement. And in fact, with in some ways minor modifications, but I think actually important modifications, i.e. just narrowing this range, which was 1.5 to 2 in terms of different participants agreeing on a consensus, and lengthening the horizon, and then also indicating, which I think would happen to some extent anyhow because of the transparency, that we're not going to just change this just because we get in the mood. There's got to be a good reason for it. That actually that would move us in a direction which would be very positive. So I think that in this context, you really want to think in both ways. And in fact, there is political economy here, which is extremely important because even if you have it perfect according to the economic model, but in fact you lose the support of the public, then you're dead. And so it's extremely important that whatever the Federal Reserve do, it has the support of the public, and in fact is supported by the political process, because a central bank that operates without the support of the political process in the long run will have some serious problems.